Hello, everyone. Andrew Karolyi, Cornell University here to talk about my research paper, Are There Too Few Publicly Listed Firms in the U.S.? It's co-authored with Craig Doidge, the University of Toronto, Chris Shen and Renee Stulz, both from Ohio State University. This paper was invited as part of the Future Directions series of the Financial Review. Thanks and shout out to editors Mike Pagano and Tina Yang. And you can see it came out in the May 2025 issue. This paper was invited as a reprise of this Doidge, Karolyi, and Stulz paper in 2017 from almost 10 years ago, in which we documented and described this really interesting empirical fact, which is the fallout in the number of publicly listed companies in the United States. It rose all the way through the 70s and 80s to a peak in 97 of about 8,000. And then there was this significant drop off all the way through, at the time of the original study, 2012. I call this the graph because it was figure 1 in our paper. What you know about the work that we did, if you followed our research, is that we wanted to understand how different the experience was in the US, that inverted V-shaped pattern, relative to the rest of the world. And it was a striking difference. If you look at the right scale here, which is the list related to the list of non-US public listed companies, that has continued to increase significantly, partly because of the number of new countries coming and becoming added into our analysis, but even organically, it's always held steady or increased. So one of the big questions that we asked was whether or not the peak in 97 in the US represented too many publicly listed firms relative to some understanding of the fundamental determinants or covariates guiding what should be the number, or too few in the 2000s that we've experienced since. And we use a panel regression framework to document that, in fact, it was the latter. We documented that this was actually a negative residual in this panel regression framework, such that it implied that in the most recent years, we were seeing an unusually short number of, too few in numbers of public listed companies in the US. We called this, and the paper itself originally, the US listing gap. We updated this data all the way through 2023, and you can see that that gap has done nothing but continued to increase to almost 7,000, what we would argue 7,000 publicly listed companies in the US that should be here that are not here, relative to the outstanding 4,000 or so that actually are. Now, in our original study, we actually tried to understand whether the decline in the number of listed companies stemmed from too few publicly listed companies coming to the fore in terms of new listings, IPOs, or whether it was the unusually high delisting rate. And I don't know if you can see there, but in the 97 period onward, you can see that the dash line, the delisting rate, deflated by the outstanding stock of the number of public listed companies the year before, so a percentage measure, was unusually higher, very different than the preceding 30 years, but it became unusually high for an extended period. So the story is that it was very much as much the unusually high delisting rate as it was the unusually low new listing rate that was associated with that decline. You can see that post 2012, in the updated decades since, that it's equilibrated a little bit more, the two a little bit more. And there's been that interesting spike there. Some really interesting studies have honed in on that post-COVID related to the SPAC boom. But you can see it seems to have been an episodic period for a couple of years post-COVID. Another part of the original study that we've updated relates to the form in which delistings take place. Voluntary delistings do happen, but you can see the line that is at the bottom of this curve is the voluntary delisting rate. That has always been relatively small, a paltry number relative to all the other forms of delistings, including for cause, for failing to meet compliance requirements. But the original headline of the study back then, and what appears to have continued to be the case for the last decade, is the unusual rate of delistings through mergers. And in the original study, we documented that this was not just from public acquirers of public targets, but also private acquirers, and not just private operating companies, but also private investment funds, private equity funds, taking existing publicly listed firms private during this period. And you can see this has continued for the last 10 years. Now, this is the last slide. This is the back half of the paper, and it was truly joy to write it with my co-authors, which really asked the question is whether this U.S. listing gap, this too few numbers of U.S. firms relative to what we're seeing around the world, really has some consequences, adverse consequences for U.S. markets. We ask essentially a series of questions, certainly not exhaustive, that we want to encourage young scholars out there to tackle. For example, who cares? Is there really a difference in a situation in which there are two separately listed firms or one larger listed firm that occurs after the merger? Does somehow fewer firms somehow mean that the economy becomes less dynamic, as somehow creative destruction that would be happening is impeded by the larger listed firms that are defending their product market space? This argument in favor of scale economies. We ask questions about whether the legal framework matters in terms of having perhaps encouraged private firms to stay private longer than what would have been perhaps more optimal by some dimension. We ask questions about the importance of the U.S. listing gap for competitiveness and concentratedness of markets. Is this somehow detrimental to our markets and to our economy? Is this evidence, as mentioned earlier, of dynamism that would be here somehow going awry? Are we missing out in the creation of startups that would only have come to the fore had they known there would be the exit via an IPO and in the public markets? And then, of course, the other logical question is there somehow now new distortions that are being introduced into the capital allocation process as a result of this overwhelmingly large number, if one would argue that, of firms that are remaining in the private space that would have otherwise come forward to the public markets? This is hardly an exhaustive list of the questions that scholars can tackle. We hope that you do. Thanks, Tina and Mike, for inviting us to write the paper, and best wishes to all.